So divide the entire consolidation process into 5 workings. If you remember these 5 workings, the life is going to be very easy. So I'll name these workings as working number 1, group structure. Working number 2, net assets of subsidiary. Working number 3, calculation of goodwill. Working number 4, non-controlling interest. And working number 5, as group retained earnings. In any balance sheet question, these 5 workings are bound to be there. Except them, we can name workings depending on what is demanded from us or what exists, like investment in associates or joint ventures can be our working number 6. If there is any fair value through comprehensive income items, fair value through OCI items, they can be working note number 7. If there is any compound financial instruments, so these are optional. As far as I am concerned, I wish to name these workings as working number 1, 2, 3, 4, 5. And in future, when I'll be talking about consolidation questions, when I'm discussing practice questions with you, I'll be talking in terms of working note number 1, 2, 3, 4, 5. So if I say working note number 3, it should automatically mean to you that I'm talking about goodwill. Working note number 4, NCI. Clear? Because in any balance sheet question, if you have these 5 workings, earlier there used to be 40-mark questions. I used to say that if you follow these workings, your 25 marks are secured. I can guarantee you 25 marks, and 15 is your application of mine. But now the pattern has a little bit changed, that instead of 1 40-mark consolidation question, there will be 4 questions of 25 marks each. I think they wish to test other topics as well with equal consideration is the reason they have taken away 15 marks from the consolidation and they wish to test it on other subjects. So they have divided the paper into 4 components now. Earlier it used to be 40 marks, 1 question, 40 marks, and which was mainly consolidation. And remaining 3 questions, 20 marks each. But the pattern has changed now. There will be 4 questions now. All of them are 25 marks each. So earlier this used to be a game changer but this used to be a burden also for people who were not able to understand consolidation process, were not able to identify how consolidation actually happens, or were not very much aware of the concepts. This was a burden for them. But for my audience or my students, were easy because I was able to secure 25 marks easily through the steps, which will continue definitely because there will be 25 mark questions each now. And if they had known other topics, it was difficult to pass the paper if someone is not aware of consolidation and if they had knowledge of other standards. But now this will be easier now if you have knowledge of other standards, and even if you know consolidation. Now the passing is becoming easier now with the introduction of 4 questions. It will be easy because if someone who was not well versed with consolidation was at the receiving end, but now if someone is not very good at it but is able to manage, then they can easily pass. But our intention is not to pass, so will not get into this. And I am never an advocate of passing. I always believe that you should always think about marks between 50 and 100, how many you wish to achieve. Never think about failing. And it is not possible that you'll fail if you are clear with your concepts. It's not at all possible. If you've done a little bit of practice and if you're clear with your concepts, no one can be below 50. I cannot even imagine it. So this has also helped me to show the pattern. Now working note number 1, group structure. The first thing we'll identify in any question or any information is what is the group structure? Who is the parent? Who is subsidiary? Whether there is existence of non-controlling interest or not. Parent is holding 80% investment in subsidiary. If there is 80% investment, then there is an NCI, which is 20%. Another thing we need to very importantly look at is date of acquisition. it was acquired at the beginning of the year, if it was acquired in the middle of the year, if it was acquired in the middle of the year, we have right only over post-acquisition profits. No pre-acquisition, because pre-acquisition profits are being acquired by the company. And date of balance sheet. The moment you look at the question, please note them down immediately. Date of acquisition, date of balance sheet, percentage, clearly defined. This is the first thing to be done. Working note number 2, net assets of subsidiary. We need net assets of subsidiary on 2 dates, one on date of acquisition, one on date of balance sheet. There is share capital, retained earnings, fair value adjustments, land, intangible assets, PP. Share capital was 100,000 on date of acquisition, it remains 100,000 on date of balance sheet. And if there is issue of shares, the information provided to you in most of the cases will be including those issue of shares. Retained earnings position on date of acquisition was 40,000, but by the end of the year now it is 60,000. Land on the date of acquisition was higher. So the information about fair value adjustments will be like this. On the date of acquisition, the fair value of land was higher by 20,000, PP by 25,000, with remaining life of 5 years. Intangible assets $20,000 or 15,000, and they were intangible assets with indefinite life. So what all values will include? So whatever is the value of the land in the financial statements, whatever is the existing value is already included as part of net assets. What is not yet included, if you remember, we are here taking care of net assets of subsidiary. Net assets means assets minus liabilities is representing net assets. We are trying to calculate the value of net assets of subsidiary. So if there is any fair value of land which is not included as part of the land, means which is not included as part of net assets as well. So only the increased portion is not included as part of net assets. So fair value of land was higher by 20,000. So the IFRS 3 business combination requires that we need to fair value the net assets of subsidiary on the date of acquisition. There's another requirement that we also need to include contingent consideration. Contingent consideration that I'll discuss as part of acquisition, not as part of net assets of subsidiary. It is a liability to be shown as part of parent. I'll discuss about it. Land was higher by 20,000. What will be the value on the date of balance sheet? What will be the value on the date of balance sheet? Hello.
20,000.
20,000 because there is no depreciation on land.
Yeah.
Intangible assets. Because it is indefinite life, it is subject to testing for impairment, but no amortization. 15,000. PP 25,000. What is the value on the date of balance sheet? On the date of acquisition, the fair value of property, plant and equipment was 25,000. 1 year has passed. It had a remaining useful life of 5 years on the date of acquisition. What will be the value on the date of balance sheet?
20,000.
20,000. Because it has suffered 5,000 depreciation. So these are the things you need to take care of when you're doing consolidation process questions, that in net assets or subsidiary, we'll be dealing with share capital, it remains the same, retained earnings, there's an increase, fair value adjustments, only the increased portion will take, not the entire amounts, only the increased portion, and we'll also check their balance on the date of balance sheet. Why we need this? Because we need to know the post acquisition profits. That the net assets of subsidiary on the date of acquisition were equivalent to 200,000, and the same net assets increased to 215,000 by the end of the year. So how much is post acquisition profits? Post acquisition profits. Difference between the two is post acquisition profits. And if the parent owns 80%, how much belongs to NCI? How much belongs to parent? How much belongs to parent and how much belongs to NCI of this profit? %80 of this profit belongs to parent and 20% of this profit belongs to NCI. Where will need this information to be included? If you remember, we need to calculate non-controlling interest. So we'll include share of profit of NCI in the valuation of non-controlling interest. In group retained earnings, that is profit for the year of the group, we'll be including. So whatever is the share of profit from subsidiary will be included as part of group retained earnings. 12,000 will be included as part of group retained earnings. I'm writing here working note number 5. That is group retained earnings, and working note number 4, NCI valuation. We'll include it there. The third thing is calculation of goodwill. Working note number 3. Calculation of goodwill. Now, before I begin, I should make clear that valuation of goodwill is dependent on valuation of NCI, non-controlling interest. Valuation of NCI determines valuation of goodwill because there is a choice that if non-controlling interest is valued on fair value, then goodwill is belonging to parent plus NCI. So there are two things. There is a choice in valuation of NCI, not in valuation of goodwill. There is a choice to value NCI either on proportionate basis, either on proportionate share of net assets, or fair value basis. Now, if you are valuing NCI on proportionate share of net assets, it is known as partial goodwill. NCI on proportionate basis. Goodwill belongs to parent only and also known as partial goodwill. NCI is valued on fair value basis, NCI on fair value basis, then goodwill is known as goodwill belongs to parent plus NCI. And this is known as full goodwill method. Under IFRS, we use pooling of interest method to value goodwill. Sorry, we do not use pooling of interest method nowadays. We use purchase goodwill method. So this is known as purchased goodwill method. We used to use pooling of interest method earlier, and nowadays we use purchase goodwill method. Pooling of interest method simply meant that there was no fair valuation of net assets of NCA. It was directly compared with, the consideration was directly compared with the book values, and whatever was the difference was recorded as part of goodwill, and it was subject to an impairment of 40 years in US. this is going away, the pooling of interest is going away, and we only have one method. This is known as purchase goodwill method. Purchase goodwill method also has two components depending on how the NCA's valuation is done. If NCA is valued at fair value, the goodwill is known as full goodwill. If NCA is valued at proportionate share of net assets, it is known as partial goodwill. Let's see what is the difference, how the goodwill is calculated. Fair value of consideration. Consideration means how we are going to purchase this entity. It can be purchased through cash, it can be purchased through share exchange. There may be deferred consideration, and there may be contingent consideration. This was compared with fair value of net assets of subsidiary. Along with it, the value of NCI was also included. The value of NCI. So if the investment is 80% and NCI owns 20%, if we are paying cash, we are paying in terms of share exchange or deferred consideration or contingent consideration, what is this representing? This is representing 80%. The total payment towards acquiring this company is representing 80%. This NCI component is representing 20%. And this total is being compared with 100% fair value of subsidiary. And any difference is known as goodwill. Suppose in acquiring this firm, there is a cash payment of 80,000. There could be share exchanges. I've written all the 4 examples purposely that there may be share exchange as well. Share exchange means you're acquiring shares in subsidiary, that for every 2 shares acquired in subsidiary, 1 share of the parent will be issued. For every 2 share acquired, 1 share of parent will be issued. And if the fair value of parent share is, now depending on how many shares are issued, suppose this is 100,000 shares, 80,000 shares acquired. How much was the share capital? 80,000. 80% shares. 80% shares means 80,000 shares acquired. For every 2 shares or for every 4 share acquired, for every 4 shares acquired, 1 share of parent will be issued. That means 80,000 divided by 4 into 1, 20,000 of shares of parent will be issued, and if the fair value of parent share is 20, then the total value in terms of share exchange will be 40,000. Did you get this? That if a parent is acquiring shares in a subsidiary, for the number of shares acquired in subsidiary, if parent, instead of paying cash, if they issue their own shares, there is a fair value of share of a parent in the market. So whatever is the number of shares issued by parent, whatever is the fair value of those shares in the market becomes the part of consideration to be paid to subsidiaries owners. Whosoever are selling their shares, it becomes as part of consideration. So 80,000 paid as in the form of cash, 40,000 in terms of shares. Deferred consideration. Deferred consideration means that 50,000 will pay after 3 years. 50,000 to be paid after 3 years. So I believe that the present value of 50,000, which is to be paid after 3 years, today is equivalent to 32,000. Just an assumption. So this is a cash payment of suppose 120,000. Fair value of share exchange 40, 32,000 in form of deferred consideration. There's one more thing of IFRS 3 business combinations. Now, when one company is acquiring another entity, the party which is selling themselves, they boast off a lot about them. They say that you need to pay us this much of money because our profits will be this much, or our revenue is going to be very high in the next 3 years. We are going to grow at an exponential pace. So the buyer is also smart. Buyer says that if the revenues reaches this point, we'll pay you additional money. If the profits reach this point, we'll pay you additional money. Whatever you are promising or whatever you're over promising, let's attach a contingent consideration to it. That if the target or if the sayings which you are telling about the growth of the company, they become true, we'll pay you more money. So they may say that we'll pay you 1 lakh more if it happens. So this requires fair value contingent consideration. That what is the fair value of this contingent consideration? That what is the probability of this happening or not happening? So there is a fair value of contingent consideration in the market. We need to fair value this. Fair value of contingent consideration. This is different from the contingent liability under IAS 37, contingent assets and liabilities. Contingent liabilities are not disclosed in the financial statements. This is for the first time coming into the books because a fair valuation of contingent consideration is also being done at the time of acquisition. There is a value being attached to it. There is a value being assigned to it. This is different from IAS 37. This is a concept of IFRS 3 business combination. Please do not mix it up simply because of the word contingent. Do not mix it up with contingent liabilities. This is contingent consideration, a concept of only IFRS 3 business combination, which has a fair value. So the fair value of the contingent consideration is, suppose, 43,000. So what is the total consideration being paid by the parent? Total consideration being paid by the parent to acquire 80% shares. Total consideration being paid by the parent to acquire is 120 plus 40 plus 32 plus 43. 235,000 is the amount being paid by the parent to acquire 80% shares. What is the fair value of net assets or subsidiary? From where we'll get this value? We'll get this value from working note number 2. We calculated the fair value of net assets or subsidiary in working note number 2, if you remember. That is on the date of acquisition. We need to know the fair value of net assets or subsidiary. It was 200,000. Fair value of net assets or subsidiary is 200,000. What is the value of NCI? Now, if I value NCI on proportionate basis, what is the value of NCI? Proportionate basis. Can you tell me the value of NCI on proportionate basis? Fair value of net assets or subsidiary is 200,000. What is the value of NCI? What is the value of NCI? $40,000. Value of NCI is 40,000. So total value of the firm, which the outside market is trying to value, 80% value is 235. For acquiring 80%, someone is ready to pay 235. The value of remaining 20 is 40. The total value of the firm, which is projected by an outside party, is 275,000. The fair value of net assets or subsidiary is 200,000. So the amount over and above is 235 plus 40 minus 40 is goodwill. This goodwill is belonging to parent only. Because NCI is valued at proportionate share of net assets, there is no value assigned to it. Can I write it in this manner? Is there any other mathematical way of doing the same thing? If you are acquiring 80%, why don't you take only 80% fair value of net assets subsidiary? Why don't you compare? If you are acquiring 80% and to acquire 80%, if you are paying 235, and if the fair value of net assets subsidiary is 200,000, why don't you take 80% of net assets subsidiary to compare? What do you think? Shall we do it in different mathematics? Let's try. Fair value of consideration to acquire 80%. 235,000. Fair value of net assets acquired. How many net assets acquired? 80% into 200,000, 160,000. How much is goodwill? How much is goodwill? Can I say this is the goodwill belonging to parent only because I paid, or the entity paid 80%. Entity paid for only 80% net assets, which was 160, and for acquiring 80%, they paid 235,000 to acquire 80%. Can I say this goodwill is belonging to parent in full? Earlier, there was no choice to value goodwill. There was only one method, which was proportionate. NCA was valued on proportionate basis. So some of the accountants argued that this is not a fair way of presentation. There should be a choice that NCI should be valued on fair value basis. If NCI is being valued on proportionate basis, it is not fairer. We want to assign goodwill to NCI as well. So this was the method we used to do earlier. So our mathematical calculation also used to be this. So before IFRS 10 or before this choice was introduced in IFRS 3 business combination, our mathematical calculation used to be this, that we used to compare the fair value of consideration with fair value of net assets acquired with 80%, and we used to record goodwill. That's it. Our job was over. But since there was a choice introduced, so what is the manner of presentation? The manner of presentation changed to inclusion of fair value of consideration. Instead of fair value of net assets acquired, it used to be, it started getting converted into fair value of net assets subsidiary, and this line was included 20% value of NCI. If you see net, it is indirectly 160 only. 160 is being compared with 235 indirectly. 160 is being compared with 235. This used to be the manner of presentation earlier, but this is the new manner of presentation wherein we record. What is the new manner of presentation? New manner of presentation is fair value of consideration. We include value of NCI in it. And instead of comparing with only 80%, we compare fair value of net assets of subsidiary. What difference does it make? Fair value of consideration is 235,000. Value of NCI on proportionate basis is 40,000. We just calculated 40,000. And fair value of 100% subsidiary is, instead of just taking into account 80% subsidiary, we are saying full value of 100% subsidiary, that is 200,000. The goodwill is, so this is simply a different mathematics because the manner of presentation has changed to include value of NCI on proportional basis. This is how we value NCI belonging to parent only when the value of NCI is done on proportionate basis. When NCI is valued on proportionate basis. What will change? What will change if NCI is valued on fair value basis? Only this one single line will change. Only this one single line will change. NCI valued on fair value basis. Fair value basis. There are 20,000 shares of NCI. 20,000 shares of NCI. And fair value of share in the market is 3 per share. What is the value of NCI now? 60,000. What difference will it make? The goodwill amount has increased from 75 to 95. So if you notice here, only one line changed and which impacted goodwill. So that's why I say that valuation of NCI determines valuation of goodwill. Did you notice? Valuation of NCI determines valuation of goodwill, and this goodwill is known as full goodwill. This is belonging to parent plus NCI. Parent plus NCI. Did you get the difference between the two? If NCI is valued on fair value basis, the goodwill calculated is known as full goodwill. It is belonging to parent plus NCI. If NCI is valued on proportionate basis, the goodwill calculated is belonging to parent only, and I have proved this by showing this calculation that it is belonging to parent only. I've shown the mathematics. Is there any doubt in this? So you need to, from exam point of view, you need to be careful about, the examiner will tell you it is company policy to value NCI on proportionate basis or on fair value basis. If the question is silent about policy, and if the fair value of share is given, value NCI on fair value basis. If the fair value of share is not given, we have no choice other than calculating it on proportionate basis. Any concerns, any doubts in calculation of goodwill? Hello? Anyone having any doubt in understanding these fair value consideration parts, cash, share exchange, deferred consideration of fair value contingent consideration? Hope this is clear, but this is the crux of the thing. This is the main thing wherein people get stuck, and if you understand this, you almost calculation of goodwill is clear, and even the consolidation component, which is complex, is clear. Please share if there's anyone. Akash, what do you mean by your question? In what cases separate methods are used? Means what? It's a company policy. If you wish to value your NCA on proportionate basis, you use. It's a company policy. That's what I said. That if you wish to use valuation of NCA on proportionate basis, you choose that. If you wish to value your NCA on market value, to include goodwill amount, to inflate the goodwill amount, because if you include market value, your goodwill amount also gets increased because of it. But it is subject to more impairment as well. So it has both its benefits and effects. So goodwill amount will be higher. If you wish to show your goodwill higher, then you use fair value model for NCI. But if you do not wish to inflate the goodwill, you only wish to show the goodwill of parent only in the consolidated results, you do not wish to show the goodwill of NCI, then you choose proportionate share of net assets for valuation of NCI. Is this clear, Akash? What is the status with others? Akash, Bhanu, Birpal, Hema, Manoj, Uday, Pankaj, Sapna. So Kshitij, we do not calculate the fair value of contingent consideration. We involve a valuer to value it. We as accountants simply include that value as part of our calculation. And at the end of the year, now on the date of acquisition, you have calculated fair value contingent consideration as 43,000. Fair value contingent consideration on date of acquisition. So you'll notice that the balance sheet provided to you do not have this line even. The balance sheet provided to you will not have this line as part of parent's books. So this is kind of a liability of the parent. Liability of the parent. So notice that either this is included as contingent consideration 43,000 as part of their balance sheet, or either it is not included. If it is not included, you need to include it on the date of acquisition. Now on the date of balance sheet, we need to fair value again. On the date of balance sheet, the fair value of contingent consideration may turn out to be 51,000. Fair value contingent consideration. So we'll increase the amount of fair value contingent consideration in the balance sheet to 51,000, and the difference of 8,000 difference of 8,000 is charged to working note number 5, group retained earnings. Because this increases our expense, we'll show it as part of group retained earnings. Kshitij, is this clear? Hello, Kshitij. Anyone else having any doubt or any concern? Uday, Pankaj, Sapna, Manoj, Hema. Give me some confidence that you're comfortable. If you're comfortable, I can keep carry on at the pace and speed I'm going on. If there's any doubt, please ask. Because when there is no reply, either it is understood very well or either there's some confusion. So you wait for the chapter to get over, study on your own, and then you wish to come back. That day will never come. Please don't get into this. That day will never come that you get time to go through it and then you'll come back and then you'll ask those queries. If there's any query, please ask it immediately. Okay, thank you. This is one of my favorite topic. Everything is very scientific and smooth. Now this also has a relationship with impairment. Whether your NCI is valued on proportionate basis or fair value basis, it also has an impact on impairment. The impact on impairment of valuation of NCI. What is the impact? If NCI is valued on proportionate basis, the goodwill calculated is belonging to parent only, is belonging to parent only. So how do we test for impairment? If the goodwill is representing, only parent share, how do we test it? Now the goodwill on proportionate basis, goodwill on NCI on proportionate basis and goodwill, well, NCI is on fair value basis is different if you noticed. Goodwill when NCI is on proportionate basis is equivalent to 75,000. But when goodwill when NCI is on fair value basis is equivalent to 95,000. And if we have to test it for impairment, we have to make an adjustment to goodwill. Adjustment to goodwill and calculate notional goodwill to represent 100%. So this 75,000 is representing 80%. To make it 100%, we calculate notional goodwill. So notional goodwill representing 100% is 93750. This will be the amount included as part of recoverable amount of the asset. If we are trying to know the recoverable amount of a CGU or the goodwill to be included as part of the entity, if we are trying to know the recoverable amount, if it gets impaired, if you remember IAS 36 impairment of assets, the synergies of business combination, the goodwill so calculated is divided onto all the units which are going to get benefited from the synergies of business combination. And the order of impairment was that if goodwill exists, we'll first impair goodwill in full and then on pro rata basis to remaining assets. If it is without goodwill, then there wouldn't have been any problem. But if there is a CGU with goodwill, then we need to allocate goodwill to that CGU, and first we'll eliminate goodwill on impairment and any further impairment on pro rata basis. Now, when we are trying to compare this goodwill with recoverable amount, we need to include the notional goodwill. We cannot include directly goodwill of 75,000. We need to include 93,750. This becomes part of net assets of that entity, and this gets compared with recoverable amount. The net assets of that entity, how much is the fair value of net assets of the parent or of that CGU to which this goodwill is allocated? Whatever is the value of the net assets, that value of net assets is being compared with the recoverable amount, and any impairment is charged to parent. How it charged? Impairment loss. Impairment loss debited, credit, goodwill. Now this reduces only parents' goodwill, and this debit will go to working note number 5, group retained earnings. Now I assume that goodwill is impaired by 26,000. What will be the entry? Include 26,000 as part of group retained earnings, working note number 5, debit, credit goodwill by 26,000. The balance of goodwill remaining in the balance sheet will be 75,000 minus 26,000 because it is belonging to parent only. This is how we'll calculate notional goodwill when we have calculated value of NCI in proportionate basis. This notional goodwill is for the sake of comparison with recoverable amount. For comparison with recoverable amount, because recoverable amount is representing 100%, so we need to compare the 100% notional goodwill. What is the recoverable amount comparing with the 100% notional goodwill? How much will be allocated to goodwill? So if it is impaired by 26,000, we'll charge directly all the 26,000 to working note number 5 to parent's goodwill, and goodwill gets reduced. What if NCI is valued on fair value basis and goodwill gets impaired by 26,000? What is the entry? Now this goodwill is belonging to parent plus NCI both. So it will be impacting working note number 5 as well as NCI. So what will be the entry? Impairment loss, debit, NCI, debit, credit, goodwill. In both the situations, goodwill will be reduced by the same amount by which it is impaired, whether NCI is valued on fair value basis or proportionate basis. But the impact is that if the goodwill is belonging to parent plus NCI, both NCI and parent should get reduced. So impairment loss, 80% of this 26,000 will be borne by the parent, and 20% of this 26,000 will be borne by NCI. So this 50 to 100 will be reduced from working note number 4, calculation of NCI, and this 20,800 will be reduced from working note number 5, group retained earnings. Is this clear? So when I'm calculating working note number 4, so this is the calculation of working note number 3, calculation of goodwill or proportionate basis or fair value basis. Hope this is clear. Working note number 4 is non-controlling interest. Now whatever your choice, it will be value of NCI on date of acquisition plus share of profit of NCI, share of profit of NCI minus impairment of goodwill. Now this is only applicable when we value NCA on fair value basis. This will not be applicable when NCA is valued on proportion basis. This impairment of goodwill is only applicable when NCA is valued on value of NCA on date of acquisition on fair value basis. If NCA is valued on proportionate basis, then this will not come into picture. If NCA is valued on proportionate basis, then it will be directly proportionate basis. Did you get this valuation of NCA? What is the value of NCA on date of acquisition fair value basis? Value of NCA on date of acquisition fair value basis is 60,000. What is share of profit of NCI? Share of profit of NCI calculated in working note number 2. Share of profit of post acquisition profits are 15,000. Out of 15,000 of profits, 3,000 belong to NCI. Impairment of goodwill. Impairment of goodwill is the goodwill got impaired by 5,200. NCI debited by 5,200. So the value of NCI to be presented in the balance sheet, this is on date of balance sheet. This is date of balance sheet figure. The value of NCI to be included in the balance sheet is equal to 60,000 plus 3,000 minus 5,200 is the amount to be included in the balance sheet in the form of NCI. But if NCI is valued on proportionate basis, then the amount to be included, value of NCA and date of acquisition, it is equal to 40,000. Share of profit of NCI. Share of profit from NCI, will get it from working note number 2, 3,000. What is the total? 43,000 is the value of NCI on proportionate basis. Now, depending on whatever is the value of NCI being done, whatever is the company policy, either NCI will be presented at 57,800 in the balance sheet, or either it will be presented at 43,000 in the balance sheet. Is this clear? Is there any other way? What is the net assets of subsidiary on the date of balance sheet? What is the value of net assets of subsidiary on the date of balance sheet? This is the net assets of subsidiary on the date of balance sheet. A proportion of it belongs to NCI. How much of it? A proportion of it belongs to NCI. A proportion of 215,000 belongs to NCI. 20%. So what is 20% of 215,000? 43,000. So you can value NCA directly as well. Fair value of net assets of subsidiary on date of balance sheet, which is 20% of 215,000, which turns out to be 43,000. So if NCA is valued on proportionate basis, you have a choice that you can present it systematically, like we did, like value of NCA plus share of profit, or you can directly apply the percentage to the date of balance sheet figure, you'll get the same amount. And this is also used for testing as well. You can test your amount, that if there is any difference, that means there's something wrong with the value you've calculated. If it is not exactly 43,000, there is something wrong with the fair value of net assets of subsidiary so calculated. So this is the total balance. 20% of it belongs to NCI, and if you're valuing NCI, working note number 4 for date of balance sheet amount, it should match. Is this clear? Now, can I confidently say that I know how to calculate goodwill? I also know how to impair goodwill. I know that there are two types of goodwill. One, goodwill will be dependent on if NCA is valued on fair value basis. If NCA is valued on proportionate share of net assets basis, goodwill is different. And if there is any impairment, if the goodwill is partial goodwill, I'll only impair group retained earnings of parent only. But if the goodwill is belonging to parent plus NCI, and if there is an impairment, I'll charge impairment loss not only to the parent, working note number 5, group retained earnings, I'll also charge to NCI. Is this clear? Please share your thoughts. If there is any doubt, please, I'll repeat again. Banu, Akash, Veerpal, Manoj, Hema, Uday, Pankaj, Sapna. Manav. All clear?
Amit, one question, Manoj here.
Yes, please.
Um, the valuation of goodwill, which depends on the valuation of NCI, how does it impact the standalone books of parent company?
The parent company will continue to show goodwill, whatever way they have calculated. Because
Okay.
it is purchased goodwill. The acquiring company shows purchased goodwill as part of their books. So they'll show the purchased goodwill.
And in case of impairment?
In case of impairment, whatever impairment they were subject to, like in working note number 5, they were subject to an impairment of 20,800. So they'll impair 20,800.
Okay.
Okay.
Yeah.
So that's why it is said that the goodwill is belonging to parent plus NCI. As part of the group financial statements, they are presenting it parent plus NCI, whatever goodwill they have calculated. In their individual financial statements, they can show it this. Because why this increases? In their individual financial statements, their goodwill will be what belongs to them, what they are paid for. They have acquired 80%. To acquire 80%, they paid this much. The difference is their goodwill. So in their standalone financial statements will be the goodwill belonging to them only. They cannot include NCI's goodwill as part of the standalone financial statements. Clear, Manoj? As part of group financials, it will be goodwill of parent plus NCI, but as part of standalone, NCI's goodwill cannot be presented as part of standalone. Earlier life was simple, that there was no concept of valuing NCI on fair value basis. This was introduced later. So we had only one way of presenting it, and life was simple that whatever we are presenting as part of group financial statements, we are presenting as part of standalone. So that's why this bifurcation, that this goodwill is belonging to parent plus NCI, this goodwill is belonging to parent only, parent plus NCI. That means the goodwill of 95,000 has a component of NCI. So if you're presenting your individual financial statements, NCI has no role in it. That is your balance sheet and your goodwill acquired. So you purchased a goodwill of only 75,000. This 20,000 additional goodwill is because of NCI's valuation from 40,000 to 60,000.
Okay. Yeah. So can I say that, I mean, in standalone books, I mean, irrespective of our valuation methodology of NCI, for parent company, it will be always based on the proportion.
Always based on whatever they have acquired.
Right. Yeah.
Yeah. So this is, the summary is good.
Yeah.
Because it doesn't make sense. Logically, there's no sense of including NCI's goodwill as part of standalone financial statements of parent. How come?
Yeah.
Isn't it?
Yeah. Right.
So among the 5 steps we have discussed, working note number 1, group structure, working note number 2, fair value of net assets or subsidy, working note number 3, calculation of goodwill, valuation of NCI on proportion basis or fair value basis, working note number 4, and value of NCI on date of acquisition and date of balance sheet. So this working note number 4 value is actually date of balance sheet value. Next comes group retained earnings. So working note number 5, why I've given these workings, so that when I discuss these practice questions with you, it becomes easier for you to understand what I'm talking about. If I say this calculation is done in, because we'll be dividing the question into workings. It will be difficult to write the name there. If we are reading the question, we'll divide the question into workings, that this component of this line will be adjusting in working note number 3, this line will be adjusting in working note number 4, 5. It will be easier for us. So working note number 5 is represented by group retained earnings. As I said, we are into a single economic entity concept. So we need to include all the earnings as part of the group. So it will show parents' earnings in full plus share of profit from subsidiary. Share of profit from subsidiary. From where we'll get this value? We'll get this value from working note number 2. Whatever share of profit we calculated in working note number 2 becomes the profit to be included as part of group retained earnings, which is 12,000. If you remember, I marked W5 there in the post acquisition profits because we are entitled to include only post acquisition profits as part of group retained earnings. Parents earnings are suppose 92,000, group retained earnings 12,000. If you notice, there is an impairment of goodwill, and we said that we'll include it as part of group retained earnings in a calculation, and that impairment of goodwill was equivalent to, when NCI was valued on fair value basis, impairment of goodwill was 20,800. Impairment of goodwill to be included, less impairment of goodwill. Any depreciation? So post acquisition profits already have taken into account the depreciation, and we included only after adjustments the amount to be included as part of post acquisition profits. No depreciation relating to parent, which is already included. Anything else? Any share of profit from associate or joint venture will also be included. From associate or JV will also be included as part of group retained earnings. Now comes intra-group trading. Unrealized gain or loss on sale of goods. So as I said, we'll be discussing about fair value net as subsidiary, calculate goodwill, asset of one entity, liability of another gets cancelled in consolidation. We'll discuss about goods in transit and cash in transit. This will also mean we'll deal with goods in transit and cash in transit. Goods in transit and cash in transit. This will discuss. Eliminate intra-group transactions. This we have already done. Value of NCI or proportionate basis or fair value basis. Let's deal with sale of goods, inventories, non-current asset transfers.